The management of Max Estates to understand what's happening in the NCR region in terms of property, where the rental income for Max Estates is likely to move, and how things are essentially looking up for the commercial rental market, which is very important. Commercial rental market always does well when there is vibrancy in the economy. When long leases are tied up, when you're ready to take, when a company or an organization is ready to take a 5 to 10 year view. So let's connect with Rishi Raj, COO of Mac Estates. Rishi, fantastic to have you on ET Now. Thank you for joining us. There is a lot of buoyancy in the NCR region in terms of both residential offtake and commercial offtake. Do you think we are in for a multi-year cycle? Because historically the real estate cycles are anywhere between 7 to 10 years. If that is true, then in what level of the cycle we are in when it comes to the when it comes to the NCR region? I think you've not unmute yourself. You just got to press that button.
Yeah, sorry.
Yes, please.
Yes, great to be here, Nikunj. Before we talk about the length and the duration of the cycle, I think it's important to understand that this tailwind and the cycle that we are seeing, particularly on the residential segment, is driven by several fundamental drivers. And I'll just, for your audience, list a few. I think number one, post-COVID, there is a significant shift in the home ownership versus rental mindset. Even the younger generation is looking to own the home. The affordability quotient is all-time high. The consumer preferences have shifted and people are looking for more generous, larger spaces, well-being oriented spaces to live in. And if you also look at what has happened after COVID, while that impacted, if I may say, the low income segment population a lot more, the mid to high income segment, not only income preserved, the saving rates have been very high. And all of this is translating into what we are seeing in the residential segment. I think as far as cycle is concerned, it's anybody's guess in terms of predicting how long the cycle would last. When it comes to Max Estates, when we build our residential or any real estate related strategy, we look at these as cyclical business, take through cycle views when we underwrite any new opportunity. And our aspiration always is that we are able to preserve our pricing through cycle. And that is through bringing a lot more quality and experience in what we build. And this is very well illustrated in the commercial segment, which is where we started with a few years ago. All our commercial development came into existence during COVID, not only 100% leased, but leased at 30% premium, which is what gives a lot of conviction to us that you can build through cycle strategies versus getting trapped into the cycle.
One look at Max Estate, because there is going to be volatility in your number. Experts understand how to value a real estate company, but when it comes to the HNI investors, the retail investors, they are used to looking at quarter on quarter, which is the QSQT number, or year on year number, which is last year versus this year. But that's not the way to look at Max Estate. So how should one look at your numbers? I mean, 2 years, 3 years, what the business could be, what the profits could be?
Great. Thank you for asking that question. You're absolutely right. You cannot look at real estate business quarter to quarter. If you look at Max Estates today, which, as you all know, got relisted, is a listed entity on stock exchange. It's a pure play real estate focus, 6 to 7 years into existence. Over last 6 to 7 years, we have built a portfolio of 8 million square feet. Just to update your audience, 4.5 million is commercial, 3.5 is residential, 2 million is delivered, lots in pipeline, under design, under construction, which will see the light of the day in coming years. My guidance to the investors would be, instead of getting trapped into quarter to quarter numbers, look at the longer term trajectory. When you look at longer term trajectory over next 5 years, if I only look at what we have acquired, which is 8 million square feet, the commercial portfolio, which today we have got two assets fully leased, giving us a rental revenue of 50 to 60 crores. This is going to reach 400 to 450 crores when existing commercial asset is at peak occupancy. That's number one. Number two, if you look at 3.5 million square feet of residential that we have, the Noida, which we already launched and got very, very favorable response from the market, that we have already booked 1800 crores. Of course, it will get reflected in the top line once we hand over the possession in next 4 years. Gurgaon, which we are going to launch mid-year, which is first intergenerational product in Delhi NCR market at scale. When we underwrote it at a total gross development value potential of 3,200 crores, which again we'll see, which we will start booking mid of next year, but the revenues will start getting reflected in the P&L, the accounting P&L, 3 to 5 years from now. So that's from a longer term trajectory. We are already looking at a baseline revenue over 5 years from 110 crores today at Max Estates level to 2,500, 2,700 crores. That's baseline based on what we have acquired today. And on top of it, we will continue to add a couple of million square feet, which will give us requisite growth for the investors beyond that steady state that I just talked about. So that's how I would request investors to look at and focus on a lot more of operating parameters, operating metric to track our progress against what we have promised.
Okay, so 500 becomes 2,500. It will not happen in FY25, it will not happen in FY26, but by FY27, assuming that you are able to book proceeds from Noida, rental income kicks in, some proceeds from Gurgaon. So can I say FY27 broadly, it should be 2,500 crores?
I think FY28, FY29, because that's the, if you look at just to correct the numbers today, if you look at what is recognized in our P&L is 110 crores. Once we reach peak occupancy for all our commercial assets, it will be around 400, 450 crores. Noida is already booked. The revenue recognition will happen 4 years later. And Gurgaon again we will start seeing the booking of sales from mid next year. The revenue recognition will happen, which is to be delivered in 2 phases in 4 to 6 years. So just to come back to your year outlook, FY28, FY29.
And your profits would follow a different trajectory because there's a rental income which also kicks in, right? While, your projects from residential will start firing the top line more aggressively, there would be a cushion of rental income which comes in every year. How do you see the rental income moving this year's assumption versus FY28, if you are using FY28 as the base for both the numbers?
See, instead of giving a very specific guidance on bottom line, I think one way to help investors look at us, if you look at profit margins in commercial, the NOI is almost 95%. So that's the way you should look at commercial business. When you look at residential business, you should look at residential business PBT level margins as 20 to 25%, 25 to 30%. And when you look at that broad yardstick and you apply that to the top line numbers and you add growth to it, which is how our portfolio would grow, that will give enough indication on the runway of the profit over next several years.
Rishi, you don't own land bank. You've acquired land bank. And let's say if you have to keep on building, you'll have to keep on acquiring more land bank. Now the real estate sector is in an uptrend. And the numbers what you're telling us that looks like the sector will be in uptrend. So today we have visibility till FY27, FY28. But then after that, what happens? I mean, how will you be able to acquire land bank to keep it going? I mean, you don't have any legacy land bank.
Excellent question, Nikunj. just give me a minute to give you that perspective, because this is extremely important question. Let me answer that in three parts. Number one, beyond this 8 million square feet, we already have a clear visibility on the pipeline. We have got Delhi 1, which is 2.5 to 3 million square feet, which is an asset right at the start, prime Noida. We are acquiring through the NCLT process. NCLT has already approved a resolution plan. It is awaiting some approvals from Noida Authority. Post that, we will take over this asset. So that's one. Number two, in Delhi, on the private side of the group, there is a land holding of 100 acres plus, which is undergoing through the land pooling process. And that to us is a more longer term source of growth. And that can deliver 4 to 6 million square feet of opportunity over next several years. Coming back to here and now, we are already evaluating 10 million square feet plus of opportunities across Gurgaon, Delhi, and Noida, and sticking to our aspiration of adding 1 plus 1, approximately 2 million square feet raw material in the hopper every year. We are very confident of coming back and announcing to the market new acquisition over next 6 months. So that's about the pipeline. As far as challenges are concerned, again, if you look at, yes, market, particularly on the residential side, is getting heated up. The pricings have gone up. But in this particular market, if you look at us as Max Estates, we would be one of the few corporate developers who are looking out for such opportunities. Delhi NCR once had 120, 125 corporate developers, which overall developers, which came down to 15, 20 in 2011, 2012. Today, handful. Even if new developers come in, that is good news for the market, because size of the pizza will increase, market will mature, better pricing and practices will get established. So we are welcoming that. And in that, we are not eyeing for a large market share. We are eyeing for the indication and the guidance we have given. We are looking at 8 to 12% market share of the relevant target segment, the premium target segment, over next 3 to 5 years. So we feel very confident about delivering on this growth, even though, unlike some of the developers, we may not be sitting on huge land bank.
All right, good to have you on board. Thank you so much for giving